Here's how the Fed's interest rates impact your everyday life. Hey everyone, do me a favor, like and subscribe to support my channel. You've probably seen news outlets or headlines talking about interest rates going up, going down, or holding steady. But what all does that actually mean? When the Federal Reserve, also known as the Fed, is talking about interest rates, what they're typically referring to is the federal funds rate. The federal funds rate is a target interest rate that banks charge each other to borrow money overnight. It's not a fixed number, it's a target range. So for example, the current federal funds rate is 4.25 to 4.5. And even though Federal Reserve requirements were eliminated in 2020, banks still need to borrow money to meet liquidity and strengthen their balance sheets. So why does any of this matter to you? Well, the federal funds rate directly impacts the prime rate. The rule of thumb is that prime is the upper end of the federal funds rate plus 3. So for example, the upper end of the federal funds rate right now is 4.5, which would make prime about 7.5. Now this is important because prime sets the baseline for all sorts of loans. Think credit cards, personal loans, business loans, and some auto loans. Mortgage rates, however, are more heavily influenced by the 10-year treasury yield and the broader market, so they're not directly impacted by prime. So when the Fed raises rates and makes borrowing money more expensive, consumers might delay making big purchases that need financing, like an auto loan or maybe even a home improvement project loan. On the flip side, savings becomes more attractive. CDs and high yield savings accounts are paying more, so consumers might opt to save money over spending it. This is all a part of the Fed's strategy and done by design. By raising interest rates, the Fed hopes to reduce the amount of money in circulation, reduce demand, and hopefully lower inflation. But when they lower rates, actually the opposite happens. Money is cheap, it encourages spending and investing, and could potentially increase inflation. The Fed gets together 8 times a year to evaluate all of this, the entire economy, and figure out whether they're going to increase interest rates, lower them, or hold steady. So now next time you hear someone on the news talking about interest rates, you'll know exactly what they mean, but more importantly, how it affects you. Let me know what you think the Fed should do with the interest rates in the comments below.